Raw financial data often provides noise, not insight. Financial ratios are the powerful analytical tools that transform this data into actionable business intelligence. Our focus is on the practical use and smart application of these ratios. They serve as a critical lens to assess a company's health, efficiency, profitability, and solvency. Ratios enable benchmarking, trend identification, and uncover areas for strategic improvement or investment. Leverage these ratios to ask the right questions, make informed decisions, and drive superior financial outcomes. Understanding financial ratios begins with recognizing their fundamental nature. They are mathematical relationships derived directly from financial statement accounts. Their core power lies in transforming raw, isolated numbers into meaningful, contextualized metrics. This transformation is critical because it allows for standardized comparisons. We can track performance trends internally over time, identifying shifts in operational efficiency or financial structure. Crucially, ratios also enable robust external benchmarking, allowing us to compare our performance against industry peers, competitors, and established benchmarks, regardless of company size. These ratios matter immensely because they serve as an immediate diagnostic tool, revealing the financial health of an organization at a glance. They highlight critical strengths, perhaps superior asset utilization or strong liquidity, and equally important weaknesses that are often obscured within vast raw data. Beyond retrospective analysis, ratios function as vital early warning systems. They can signal deteriorating solvency, inefficient working capital management, or declining profitability trends before these issues become critical problems, enabling proactive intervention and strategic adjustments, rather than reactive crisis management. To effectively analyze an organization's financial health, we categorize ratios into distinct groups, each addressing a specific dimension of performance. Liquidity measures an entity's immediate financial agility, its capacity to meet short-term obligations without financial distress. This is crucial for day-to-day operations and managing working capital efficiently. Solvency extends this perspective to the long term, assessing an organization's structural financial stability and its ability to meet long-term debt commitments. It speaks to the sustainable capital structure and risk profile critical for lenders and long-term investors. Profitability ratios are central to evaluating how effectively a company generates earnings relative to its expenses. They reveal the ultimate success of the business model, encompassing everything from gross margins to net income, and ultimately the return generated for shareholders. Efficiency ratios delve into operational effectiveness, measuring how productively resources, whether assets, inventory, or receivables, are utilized to generate sales or manage operations. These metrics are vital for identifying operational bottlenecks, optimizing processes, and enhancing asset turnover. Finally, market valuation ratios bridge the gap between a company's financial performance and its perception in the capital markets. They link accounting numbers to stock prices, providing insights into investor sentiment, growth expectations, and the overall value proposition of the enterprise. Understanding these ratios is paramount for investment analysis and assessing shareholder value. Focusing now on specific categories, we begin with liquidity ratios, which are fundamental to assessing an entity's immediate financial health and its ability to meet short-term obligations. The current ratio is our broadest measure, calculated as current assets divided by current liabilities. A benchmark of 1.5 to 3.0 is generally considered healthy, indicating sufficient working capital without suggesting an inefficient overaccumulation of current assets. It provides a foundational understanding of an organization's capacity to cover its liabilities within a year. Next, the quick ratio, or acid test ratio, offers a more stringent view. By excluding inventory and prepaid expenses from current assets, it focuses on the most liquid assets, cash, marketable securities, and receivables relative to current liabilities. A benchmark of 1.0 or higher indicates strong immediate liquidity. This ratio is particularly insightful as inventory can be slow-moving or difficult to liquidate quickly without significant discounts, making the quick ratio a more realistic gauge of immediate cash-generating capability. Finally, the cash ratio provides the most conservative measure of liquidity. It considers only cash and cash equivalents against current liabilities. A benchmark of 0.5 to 1.0 typically suggests adequate cash reserves. While lower than other liquidity ratios, it critically reveals an organization's absolute immediate cash position to meet its most pressing short-term commitments. Analyzing these three ratios together provides a comprehensive and nuanced picture of an organization's short-term financial resilience, moving from a broad assessment to the most liquid available resources. Shifting our focus from short-term liquidity to long-term sustainability, we examine solvency ratios. These metrics assess an organization's ability to meet its long-term financial obligations and provide insight into its capital structure and overall financial risk. The debt-to-equity ratio is a critical indicator of leverage. Calculated as total debt divided by total equity, a lower ratio is generally preferred. A high ratio signals greater reliance on debt financing relative to equity, increasing financial risk due to higher fixed interest payments and a potentially weaker equity cushion against losses. It directly reveals the extent to which a company's assets are financed by creditors versus shareholders. Next, the interest coverage ratio measures an entity's ability to service its debt obligations from its operating earnings. Derived by dividing earnings before interest and taxes, EBIT, plus interest expense by interest expense, a higher ratio is unequivocally better. This metric demonstrates how many times a company can cover its interest payments with its pre-tax, pre-interest earnings, providing a vital gauge of debt servicing capacity and financial health from an operational standpoint. Finally, the debt ratio, calculated as total liabilities divided by total assets, provides a direct measure of the proportion of a company's assets financed by debt. A lower ratio indicates less overall leverage and consequently lower financial risk. It offers a comprehensive view of how much of the company's assets are claimed by creditors versus equity holders. Collectively, these solvency ratios illuminate the structural financial stability of an organization, its reliance on borrowed capital, and its inherent capacity to withstand financial pressures over the long term, which is paramount for sustainable growth and access to future financing. Moving into the heart of any business's success, profitability ratios are paramount. They assess an organization's capacity to generate earnings relative to its revenues, assets, or equity. The gross profit margin is our first indicator, calculated as revenue minus COGS divided by revenue. This ratio measures the direct efficiency of production and the effectiveness of a company's pricing strategy. It tells us how much profit is left from sales after accounting for the direct costs of goods sold before any operating expenses. Next, the operating profit margin refines this view. By taking operating income divided by revenue, it reflects the operational efficiency of the core business, isolating profitability from non-operating factors like interest and taxes. This ratio is critical for understanding the strength of a company's fundamental business operations. The net profit margin then provides the ultimate bottom-line perspective. Calculated as net income divided by revenue, it shows the overall profitability after all expenses have been accounted for, including operating costs, interest, and taxes. This is the profit available to shareholders, reflecting comprehensive cost control and tax efficiency. Finally, return on equity, ROE, is a crucial metric for shareholders. Derived by dividing net income by shareholders' equity, it directly measures the return generated on the equity capital invested by owners. ROE is a vital indicator of how effectively management is utilizing shareholder funds to generate profits, making it a key driver of investor decision-making and a benchmark for capital allocation efficiency. Moving into efficiency ratios, these metrics are crucial for evaluating how effectively an organization utilizes its assets and manages its operations to generate revenue and cash flow. They illuminate the productivity of capital and the effectiveness of operational processes. Asset turnover measures how efficiently a company uses its total assets to generate sales. Calculated as revenue divided by average total assets, a higher ratio generally indicates greater efficiency in asset utilization. This is particularly insightful for capital-intensive industries, showing how much revenue is generated for each dollar invested in assets. Inventory turnover indicates the speed at which inventory is sold and replaced during a period. Its formula, cost of goods sold divided by average inventory, reflects the efficiency of inventory management. A higher turnover generally suggests strong sales and minimal holding costs, while a low turnover might signal excess inventory or slow sales. Receivables turnover assesses the effectiveness of a company's credit and collection policies. Calculated as net credit sales divided by average accounts receivable, a higher ratio implies efficient collection of credit sales. Conversely, a lower ratio could indicate issues with credit granting, collection efforts, or customers struggling to pay. Finally, the cash conversion cycle, CCC, provides a holistic measure of working capital management efficiency. It sums the days inventory held and days receivables outstanding, then subtracts the days payables outstanding. This metric quantifies the average number of days it takes for a company to convert its investments in inventory and accounts receivable into cash. A shorter CCC indicates a more efficient working capital management, minimizing the time capital is tied up and improving liquidity. Our final category, market valuation ratios, links a company's financial performance directly to its stock market value, offering crucial insights into investor sentiment, perceived future prospects, and overall market standing. The price-to-earnings (PE) ratio is arguably the most widely used valuation metric. Calculated as market price per share divided by earnings per share, higher ratios generally suggest that investors anticipate significant future growth, indicating a willingness to pay a premium for each dollar of earnings. It's a key indicator of market expectations and can signal whether a stock is overvalued or undervalued relative to its peers or historical performance. The price-to-book (PB) ratio compares a company's market valuation to its accounting or book value per share, derived by dividing market price per share by book value per share. It's particularly useful for valuing asset-heavy businesses and identifies companies trading above or below their net asset value. A PB ratio below 1.0 could suggest undervaluation, while a high ratio often implies intangible assets or strong growth prospects not captured on the balance sheet. Enterprise value to EBITDA (EV/EBITDA) is a powerful valuation multiple, especially valuable for comparing companies with different capital structures. Enterprise value, which includes both equity and net debt, is divided by earnings before interest, taxes, depreciation, and amortization (EBITDA), a proxy for operational cash flow. This ratio provides a capital structure neutral view of a company's total value relative to its core operating profitability, making it a preferred metric in M&A analysis and for cross-industry comparisons. Lastly, dividend yield directly measures the return from dividends relative to the share price. Calculated as annual dividends per share divided by price per share, it's a critical metric for income-focused investors. A higher dividend yield indicates a greater cash return on investment, often characterizing more mature, stable companies that return a larger portion of their earnings to shareholders, though it's essential to consider dividend sustainability. The DuPont analysis is a powerful framework that deconstructs return on equity (ROE) into its fundamental drivers. It transforms ROE from a single number into a comprehensive diagnostic tool, revealing the levers management can pull to enhance shareholder returns. At its core, DuPont breaks down ROE into three crucial components. First, net profit margin, as we discussed, measures how much profit a company generates from each dollar of revenue. This element reflects operational efficiency, pricing power, and cost control. A higher net profit margin directly contributes to a stronger ROE. Second, asset turnover gauges how efficiently a company uses its assets to generate sales. It indicates the productivity of the asset base. A higher asset turnover means more revenue is being squeezed from every dollar of assets, amplifying the impact of the profit margin on ROE. Third, the equity multiplier introduces the concept of financial leverage. Calculated as average total assets divided by average shareholders' equity, it reveals the extent to which a company's assets are financed by debt. A higher equity multiplier signifies greater reliance on borrowed capital. While increased leverage can amplify ROE by using borrowed funds to generate more earnings for shareholders, it inherently introduces greater financial risk. By dissecting ROE into these three interconnected elements, profitability, asset utilization, and financial leverage, the DuPont analysis allows us to pinpoint precisely which factors are driving changes in returns. This framework is invaluable for identifying specific areas for operational or strategic improvement, guiding decisions that can significantly impact the bottom line and ultimately shareholder value. Beyond their theoretical understanding, the true power of financial ratios lies in their diverse and critical practical applications across the financial landscape. For internal controls, management utilizes these ratios as vital performance indicators. By monitoring key ratios against preset targets or historical trends, deviations become immediate triggers for investigation and corrective actions. This proactive approach ensures operational efficiency, cost containment, and adherence to strategic objectives, essentially serving as an internal early warning system for financial health. Benchmarking is another crucial application. Companies consistently compare their ratios against industry peers, competitors, and sector averages. This external perspective is invaluable for identifying competitive strengths and weaknesses, understanding best practices, and recognizing areas where performance lags or excels, thereby informing strategic positioning. In credit analysis, lenders rely heavily on financial ratios to thoroughly evaluate a borrower's financial health. By analyzing liquidity, solvency, and profitability ratios, lenders assess creditworthiness, determine repayment capacity, and structure appropriate loan terms, effectively quantifying the risk associated with extending credit. Finally, for investment evaluation, investors utilize ratios as fundamental tools to assess company performance and intrinsic value. These metrics enable the identification of potentially undervalued stocks, evaluation of growth prospects, and pinpointing investment opportunities that align with specific financial goals and risk appetites. They provide the analytical foundation for informed portfolio decisions. While financial ratios are indispensable tools, their blind application can lead to significant misinterpretations. It is crucial to be acutely aware of common pitfalls that can distort conclusions and undermine the validity of your analysis. First, window dressing refers to the practice where companies manipulate financial statements near reporting periods to present a more favorable picture. This could involve accelerating collections or delaying payments, temporarily improving liquidity ratios without any fundamental operational improvement. Astute analysis requires looking beyond a single reporting period and scrutinizing underlying operational cash flows. Second, sector differences are paramount. Ratios inherently vary significantly across industries due to differing business models, capital structures, and operational cycles. Comparing the asset turnover of a capital-intensive utility company to a software firm, for instance, leads to invalid conclusions. Comparisons must always be conducted within the same industry or against a highly relevant peer group. Third, one-time effects can significantly distort ratio analysis. Extraordinary events such as large asset write-downs, significant litigation settlements, or unusual gains from divestitures can skew profitability or leverage ratios, creating misleading trends. Analysts must identify and often normalize these non-recurring items to gain a true understanding of a company's underlying recurring performance. Finally, accounting methods present a major challenge to comparability. Different accounting practices, such as the choice between LIFO and FIFO for inventory valuation or varying depreciation methods, directly impact financial statement line items and, consequently, ratio calculations. Without understanding these underlying accounting policies and making adjustments where possible, comparisons between companies can be inconsistent and lead to flawed conclusions. Ultimately, effective ratio analysis demands not just calculation, but rigorous critical thinking, an understanding of industry context, and a deep dive into the qualitative factors and accounting footnotes that underpin the numbers. Moving beyond the mechanics and common pitfalls, truly effective ratio analysis hinges on adopting a smart use methodology. This involves integrating qualitative understanding with quantitative insights to derive actionable intelligence. First, contextual analysis is paramount. Ratios are numerical snapshots, but their meaning is profoundly shaped by the prevailing market conditions, the specific economic cycle, and unique company-specific factors such as strategic initiatives, recent acquisitions, or divestitures. Interpreting a liquidity ratio, for instance, requires understanding industry credit terms, while assessing a growth ratio demands insight into market demand and competitive landscape. Second, trend analysis is indispensable. A single period's ratio holds limited value. Examining ratios over multiple periods reveals crucial patterns, consistent improvements, deteriorating trends, or cyclical behavior. This longitudinal perspective allows us to distinguish between temporary fluctuations and fundamental shifts in performance, providing predictive insights rather than just historical data. Third, while direct cross-industry comparisons are often misleading, smart analysis involves understanding and adjusting for industry norms and inherent operational differences. This means recognizing why certain capital structures or margin profiles are typical for specific sectors, or comparing underlying business functions across different industries while accounting for their unique operating environments. It's about insightful interpretation rather than direct numerical matching. Finally, narrative development is where the analytical process culminates. Financial ratios are data points. The ultimate goal is to synthesize these isolated metrics into a coherent financial story. This involves connecting the numbers to the strategic decisions, operational realities, and future outlook of the company. A compelling narrative explains why the ratios look the way they do and what they imply for future performance, transforming data into truly valuable business insight. As we conclude, let's crystallize the essential takeaways for mastering financial ratios and leveraging their full potential. Our journey has highlighted 5 key ratio categories that form the bedrock of financial analysis: mastering liquidity, solvency, profitability, efficiency, and market valuation ratios provides a comprehensive lens through which to assess any organization. Effective analysis then hinges on applying 3 critical dimensions: consistently examining ratios across time to identify trends, rigorously comparing them against industry peers for competitive insights, and measuring performance against established internal targets to gauge operational effectiveness. Ultimately, the most profound insight comes from adopting one integrated approach, recognizing that ratios are not standalone metrics. They must be used as an integral part of a comprehensive financial analysis framework, synergizing with qualitative factors, strategic context, and forward-looking projections. When properly applied, financial ratios are indeed powerful tools. They possess the unique ability to transform raw, disparate data into actionable, strategic insights that drive superior decision-making. Always remember this fundamental principle. Ratios themselves present figures. They tell stories, not just facts. The true enduring value and the competitive edge come not from merely calculating these numbers, but from the depth and nuance of your interpretation of the narrative they unveil.